Okay, so we are a couple minutes past the hour, so we will be going straight through for an hour and a half. And we will also add on an extra 30 minutes if anybody would like to stay on and ask more questions. I'm hoping that Keith, Nader, and Joel, you guys can stay on for that extra bonus 30 minutes, but if you're not able to, I totally understand that. So I do want to just say thank you for giving up the 1 hour and a half that you guys are giving to me. So let me share with you guys my screen. So I only have a couple of slides to share, and then we'll just jump right in on the ideas and questions that we have. So just to make sure that we're all on the same page here, I wanted to share a couple of slides with you so that we're all on the same page. So just a couple of admin stuff. We are going to be recording it and putting it out on YouTube and Facebook and social media. So right now you should only just see the panelists, the shared screen, and yourself. You won't see anybody else on camera. If you are not asking a question, please make sure that you're on mute just to keep a lot of the background noise as low as possible. And when you are asking a question, I will unmute you. And then just be very precise with your question. We don't want a lot of run-on questions, just so that we can make sure that everybody gets a chance to ask the questions. Okay, so that's just the admin stuff. And then we're going to just do a quick opening. Most of you guys know the panelists. You guys have been getting a ton of my emails advertising who they are. So we're not going to be talking about exactly, what field that they specialize in, but just know that in our current climate, there's a lot of stuff going on right now. And one of the reasons why I got this group together was so that we could help each other get past some of the fear, some of the uncertainty. And I'm just so grateful that these three gentlemen agreed to come on with me to let me voice these questions and have you guys attend as well and voice your questions as well. So I'm super happy to be able to do that. So I will give each of the panelists a couple minutes to sort of say hello. And I do have a specific question just to get the ball rolling about what their thoughts are about the current climate. And then at the very end, we'll do some closing remarks, and I have a couple of questions to help with that as well. Okay, so as you can see, our panelists, their names, and the field that they specialize in. Now, I'm an investor. I've been investing in real estate for 20 years. And so I do a lot of these sessions to do a lot of educational sharing. Keith is a mortgage agent. And now, Keith, correct me if I'm wrong, because I thought you were just doing mortgages in Alberta, but I didn't realize that you also did Ontario. Do you do other provinces as well?
East to west, including Quebec.
Oh wow. Okay, that's a huge area. Okay.
Yeah, we're fortunate because of my relationship with Mortgage Alliance. That's what enables it to happen.
Okay. All right. And Nader is an accountant. Now, I know, Nader, you also do multiple provinces as well, because I've asked you a lot of questions about accounting principles and what I'm allowed to do in Alberta versus Ontario and so forth like that. So you also cover a bigger area too than just Ontario, right? Oh, Nader, I'm not hearing you. Okay, so I will just go on there for a second. So then Joel as well. I've had the privilege of knowing Joel for a little while now. And I'm just amazed at the caliber of the experience that's on this panel. And I'm hoping that we will get a lot of good insight and support and opinions about what's happening right now and stuff that we could use in the next few months. Okay, so I want to set the stage so that we can get the most out of the brain power from these experts in the short amount of time that we have. Okay, and so I want to share with you why I put together this event. Okay. I've been investing in real estate for 20 plus years and doing buy and holds, private lending, joint ventures, equity deals. The time frame that I've been investing in real estate is now changing. And what I mean by that is if you look at the inflation historical chart, you will see that the inflation rate the entire time that I've been an investor has been below 5%. So everything that I know about real estate investing has been based on this past 20 years at the super low rate, right? And on top of that, not only has the inflation rate been super low the entire time that I've been investing, the mortgage rate has also been historically low for most of the time that I've been investing, right? What many of us may not realize that in the late 80s, early 90s, interest rates were 10+%. Some of us, some of our parents, some of our grandparents may have had properties at 15%, 20% interest rates on their mortgage rates. And so for a lot of us investors now who haven't been around 20 years ago, we are used to super low inflation rate, super low mortgage rates. And so what that means now is that we have to make investments that are going to give us higher than that inflation rate and higher than that mortgage rate to ensure that we're able to save and able to make future investments. Okay, so there's so much news out there recently, like over the last month with the war, the inflation news, the mortgage rates, that a lot of times we don't know what's real news and what's fake news, what's been sensationalized by the media, and how to filter that out so that we're able to focus over the next month, over the next 12 months to make sure that we're making good, sound, common sense, right? So I want to share a joke with you that I found about clickbaiting, right? I don't spend that much time on social media or watching TV. So I don't get caught up in that clickbait, but once in a while I will go on there and I will realize, oh my God, I just lost 30 minutes of something because I've been clicking on this clickbait stuff, right? And so a lot of times we get caught up in the news streams about what's going on, and they've been sensationalized to make things either worse for us or make them so that we think things are worse than they really are. So one of the things that somebody said recently was, you know, the common sense criteria, the principles that we've been investing with over the last 20+ years may not be common sense anymore. And that really hit me like a ton of bricks, because I'm like, okay, if all my 20+ years of investing has been in low inflation, low interest rates, and all suddenly now everything I know doesn't apply anymore, what's the new common sense? And so that was one of the questions that I had coming into this to put this event together. And then another reason why I put this event together was that some of my coaching clients came to me all within like a month period, said, Huong, this is happening right now. I don't know what to do with this. Oh, Huong, this is happening right now, and I don't know what to think about this. And it made me realize that, you know what, I had my concerns about the economy, but everybody else is also having their own uncertainties about it. Okay, so that was the biggest reason for me to gather some of the experts that I know and say, hey, let's sit down and answer all these questions and try to put people at ease, give some advice, give some tips to help people along. Okay, so before we go into all of the questions, I do have to put a legal disclaimer up. Okay. Yes, some of us on this panel are experts in our field, but please reach out to us and have a longer conversation to make sure that you understand what it was that we were trying to convey, and make sure that before you implement anything, that you do get that professional advice, that one-on-one independent counsel before you implement anything. Okay. And also keep in mind that we do not have all the answers, okay? And which is why I said, like, if there's a question that I ask and, you know, if you're on the panel and you don't know the answer to it, or if you don't have an opinion, we can just totally pass you, and that's totally fine, okay? So, but what we want to do is pick your brain and get as much information as we can so that we can take action over the next 12 months that is going to benefit us, so that we are able to continue to grow our portfolio and not just have to survive the next 12 months. Okay, so I am going to throw up a poll for everybody. This is a very short poll. It is confidential. And the reason for the poll is so that the panelists and myself, we can then gauge our answer to you to make it so that it's relevant to you. Okay, so please take a couple seconds and just fill it out. There's only 7 questions. It is confidential, and it's really just to help us understand who is with us right now. Okay. Okay, and I do see a bunch of questions in the chat, so that's great. All right, perfect. Okay, so I do see some of the answers coming in. That's fantastic. Oh, Nader, I just saw your thing about unmuting you. Sorry.
Good, thank you.
All right.
I can only put in one to each question. Is that the theory?
Yes.
Okay.
Yes. I think at the very last one. No, yeah, no, it's only one option. Okay, so we got about 60% participation rate. So I will give it a couple more seconds just to make sure that we get as many people as we can to answer that. Okay, disclaimer. Okay. Okay, so I'm gonna close the poll in 5 seconds, and I will share the responses so that way the panelists can see the results, and then we can sort of gauge our supporting answers to help you guys along. Okay, so 4, 3, 2, 1. Okay, so I'm going to share the results, so you should see that. And I will open it up for questions. So feel free to type in the chat box if you have a question. And the outcome that I want for all of this session and for all the questions is really so that over the next few months that we can make decisions that are sound, unemotional, profitable at the same time, and giving us more of the life balance that we want. I recently met a couple who basically are buying a pizzeria for almost $500,000. And my initial reaction was, wow, that's a lot of pizza you have to sell, right? But when I spoke to them, they were purchasing it with a lot of emotion in the sense that they wanted to not have to worry about a 9-to-5. So, you know, I'm sharing that because I want us to be able to make investment choices that are going to benefit us in the end, and that isn't going to make us, you know, bankrupt or potentially be worse off in a year's time, right? So the results are up, and as you can see, most of us, there's about 50% of us who are uncertain about what's happening around us. Okay. Okay. Okay, and then most of us have less than 10%. It looks like most of us, 50% of us have most of our stuff in real estate. So we are talking to the right group. Okay, good stuff. Okay, perfect. So I will stop my share and we will open it up to the first question. Okay, so I will start and ask you guys the first question. Okay, so question number 1, what is your position or thoughts on the current events that are happening right now, globally and locally, relating to war, inflation, stocks, real estate, the bubble, and the Alberta recovery? Who would like to tackle that one?
All of them at once in one question?
All of them at once.
One question? I thought you said what you had one question.
One question at a time, you said. War,
Joseph's like, I'm done.
Stocks, Alberta.
I'm throwing Alberta in there because over the last 6 months, I've gotten so many comments about Alberta's recovering. Alberta's recovering. Huong, you've lived in Edmonton. It's time to buy in Alberta. Right? And I question whether or not Alberta is really out of their slump.
So here's the thing. It's always been the time to buy in Alberta. Because Alberta is landlord friendly. with the Tenancy Act. Cash flow has always been possible with what it had been possible with condos and townhomes. A little more difficult. Condos, townhomes, or single family houses than it once was. But legally suited houses, legally suited duplexes, fourplexes, those have been cash cows for years in Alberta. It's just the people of Ontario and BC are now finally taking full notice that that's the case, and they're not willing to accept negative cash flow or minimal cash flow in Ontario and BC based on the property prices, realizing they could come to Alberta and buy 2 suited fourplexes for the same price of buying 1 maybe suited home and have way more cash flow. Now, it's all about what is your future plan. If somebody's future plan is based purely on market value increase, which no investor ever should just buy off of market value increase, because that's the gravy, you should be buying for cash flow. If you want cash flow, Alberta's the place to be, the place to have been, and the place to go for the future.
So Nader, I want to pick your brain about that. So because cash flow from properties are going to be taxed.
Yes. So, but okay. So are we tackling Alberta? So actually, to add to what just Keith was saying, I was reading an article yesterday that these oil prices have seriously helped Alberta's economy, and because the oil price has gone up all over the world. So that is seriously impacting Alberta's economy, and it will impact how much faster they are coming out of the long-term recession and on being unfavorable province, because they were in the oil industry and the politics of who is in power in the federal government. So it has helped them a lot. So Alberta, yes, it is right now benefiting seriously from what is happening all over the world. And it is truly one of the better places that I think, yes, you can invest. Considering I was just talking to another investor, developer in Ontario, but he's developing over 120 units in Nova Scotia. And one of his investors, who was a real estate agent, out of 6,000 emails that he sent to 6,000 people in his email list, he was only pre-sell 1 property, 1 unit in a condo unit. So it has seriously impacted the Nova Scotia, the slowdown that everybody's talking about in the real estate industry, and somewhat slowdown in Ontario. But from what I see in Alberta, Alberta is picking up right now. So is it at the bottom? Yes. Is it the time to buy? I can't say most definitely, but it is one of the better provinces right now to invest, because all the others are going through either the slump or slow down. And so we'll see what happens. But Alberta is in a better situation economically right now. And to speak a little bit about, because to go back to the origin of your question, where we are with the economy, right now there are 2 forces, fighting forces. One was the inflation that the federal government and everybody, finance department, is trying to tackle. Bank of Canada recently raised the rates. They are thinking they are going to raise it another 4 times by the end of the year. And then the war in Russia happened. Unfortunately, with war is that it slows the economy. It pushes up the prices. The governments need to stimulate the economy. So this is having a counter effect on the inflation. At the same time, the prices are gone up and some parts of the economy are slowing down. So we got to see how these 2 impact each other. They were saying they're going to raise it by 4 times by the end of the year, but the day before yesterday, I read an article, or yesterday I read an article, it said it's going to be maximum 2 or 3 times because of what is happening in the impact of the war in Russia and Ukraine is having on us. So it is right now in the crossroads of where we go. Either inflation takes the center stage and we need to tackle that and raise the rates, or the war in Russia gets prolonged and there's going to be shortages of veggies and legumes and corn already. So wheat, other grains have been already impacted. The prices have gone up. So then the government is going to step in to stimulate the economy. So we're going to see where these two impact and how much they impact and how much the war in Russia impacts us and how much longer it's going to be. So this is right now at the crossroads that you can't exactly say where we are going. If it was a month ago before the Russia war, yes, government of Canada was going to, and US, they were both going to raise the rates and slow down the economy. But we will see how bad things are going to be by the end of the year.
And now one of the things that a lot of people don't understand when they look at the inflation and the supply chain, typically inflation is connected to a performing economy. Gross domestic product production is up, incomes are up, wages are up, all those things. In our current inflation is, use the term false inflation, because it's a supply chain issue. We've got thousands of containers sitting in ports that are not yet emptied and getting to the consumer. And so there's a bit of a false inflation with that, in that as we finally start to get the movement of goods, that's going to be better. Now, the one thing I'm going to pile on top of what Nader just said is, now we got the reports of major shutdowns in China again.
Exactly.
Because of coronavirus outbreaks. So now that, my sister happens to be a rep for a alcohol producer. And one of the things they're running into is the cost and ability to get cardboard to package their products to send them out. And then the containers, getting the glass containers to put the alcohol in. That's just one industry, an example from one industry that's impacted by these things. So just be aware, like, there's so many things that raising interest rates is not going to get materials moved from the port to the shelves to the table. And that's where there's been, my personal view is that's where there's been missing information in the news and the media about why we have inflation. Because people who are low income, middle income are going, well, I'm not earning anymore. The COVID has not enabled me to negotiate higher wages or anything like that, but yet I'm taking a bigger hit at the till. How am I, now, a lot of people are unfortunately taking from Peter to pay Paul. And so inflation goes up, the amount of debt people take goes up, and then the government says, well, we got to slow things down. People are taking on too much debt. We got to hit the housing market, right? Well, we've got to do this to the housing because people are taking on too much debt, when the result of things such as debt are more a leg of wages right now than anything, because companies coming out of COVID are trying to recover. In some cases, they're trying to recover capital to build up capital. In other cases, they're trying to just rebuild their clientele and generate income. So there's so many things. I mean, Alberta oil and gas is not as big a percentage of what Alberta has done in the past. Manufacturing, agri-foods, and tech are certainly much bigger than they were, as well as transportation. The reason Calgary's transportation hub and storage has gone up so big is because products are coming into the port in the West Coast and they're heading straight to the warehouses in Calgary, because Vancouver just doesn't have the space to build these warehouses for these products. And then, so in some cases, products are going from the West Coast to Alberta and then back into BC. So that's part of, that's a part of this whole thing that's going on. And is it good for Alberta? Yeah, great. Is Alberta going to be able to come out the other side with a surplus? Yes. Does it mean that the Alberta government's going to be able to give things back to the people? Probably not.
So you raise a good point there. So one of the questions that I have was about diversifying out of real estate. And stocks is one option, but what about now diversifying into agriculture or some sort of sustainable industry that benefits everybody more than just real estate or stocks?
I think Joel should answer this one.
Yeah, I add a couple of sentences to it.
Well, I go away from the real estate side to what other opportunities and how much diversification do you want to do for your own financial planning? And markets go up and down and different sectors go up and down. And it's nice to have some kind of a mix if you can get there. And once you've got assets, you can borrow against assets and get credit, which makes you someone more likely to get other financial partners or investors if you're comfortable doing that kind of work. That's how I got started, was buying a small property and then the next one and next one, and gradually got into a neighborhood that had been residential and then small commercial, but had faded. It had passed its time. And I'm an American, and I'm talking about Nashville, Tennessee, Chattanooga, Tennessee, as the two primary places that I have my history. But then I moved to Canada and I started to buy some properties here. And some of those are urban and some of those are rural, and they are personal in a way. They're not intentionally bought for quick flipping or things like that, but it's extended family and helping a kid buy property and being the guarantor and just using the methods of real estate and financing and partners. And I'll just leave it there to give. I'm just giving you a bit of an introduction about me and how I think about it for now.
So to add to what Joel was saying, to get into another field and to diversify, you got to be careful you understand that field, whether it's agriculture, or if you want to get into stocks, or if you want to get into precious metals like gold and silver, or buying into business.
Yeah,
you got to do your homework. You got to research it. You got to understand it. You got to feel comfortable. Getting into, because I do business analysis every day, and everybody comes in and says, should I buy this business? Should I not do business? So as an investor that they are getting into, the first thing is, how involved are you going to be? Are you going to be a 10%, 5% shareholder, and you're going to be silent and you're going to have no words whatever to say about the business because somebody else owns 95% and you have nothing to say about it? Or are you getting into it 100%? You want to sell all your life and get into a restaurant business. So you got to assess what you're comfortable with and understand the business. What does it require? So if you want to buy it, look at the numbers, do the financial analysis, do the ratio analysis. Who are the owners? Can you get along with that owner? Is it a large company? Is it a small company? Are you going to be how involved are you going to be with the presidents, and you're going to be making decisions or not, or would they share their decisions with you or not? How comfortable are you with that business? And then getting exactly to what you were just saying before, is it some getting into a coffee shop? I've seen people, restaurants buy coffee shops, and then they see that, holy cow, it requires me to spend 18 hours a day in the coffee shop. But how are the others doing? The others are hiring 14, 15, 16-year-old, 18-year-old students or new immigrants, and then just looking at it as an investment. So is this a small business you buy? Is it viable to put in a manager and a dozen students to run it? Or is it something that you got to run it yourself? So you got to do, if you're diversifying, make sure you do your homework. You understand exactly what you're getting into. I do real estate analysis, and real estate analysis is a lot easier and simpler. And within 1 hour, the real estate agent says, yes, this is a good neighborhood, this is a good property, these are the numbers. And then I sit down and I analyze the numbers. But when you're getting to diversify, get into new, totally new field and new business, make sure you understand that business, make sure you're comfortable with it, and do your due diligence and do your numbers.
Yeah, I believe that you need to work with, if you're going to diversify, whatever it is, if you've only been in stocks and you've done training in stocks, now you want to buy real estate, you build a team and work with professionals that have invested in real estate. If you want to buy private equities, you go and you interview and you talk to somebody who's a representative, a private equity firm that represents private equities, and have them educate you so that you understand what it means to buy private equities. If you want to do that with Bitcoin, you do that with Bitcoin. Whatever it is, if you're going to do that through GICs or stocks or mutual funds or ETFs or whatever it is, then you go and talk to professionals in that field and get different thoughts and feelings and opinions on those different products, so that if you are going to go that route, you're making educated decisions based on information from professionals, not information from your uncle at the dinner table, your friend who lost money in stocks, or had got a divorce and because their husband or spouse lost the money, or whatever it is, right? That's why you need to have trusted professionals that you work with, is so that you can make those types of diversified choices in the right way for the right reason, based on what your long-term wealth plan is for yourself. And that's crucial. It should never be a conversation just about what I want to do today. It's about, what do I want for tomorrow and beyond, and what actions do I need to take today to make sure that I can fulfill that.
So I'm going to ask Lana to come on, because she had 2 questions here, and I think it would be great for you guys to answer those. Hi, Lana.
Hi. Put me on the spot. So my questions were, and I put it in the chat here, with everything that you see on social media and with investment firms talking about their products and some of the real estate companies, there's a lot of inaccuracies in the social media sites nowadays, and some of the marketing schemes are very, they're very good and catch a lot of people off guard. So I'm wondering, how are we supposed to, understand everything if we don't have, like a financial broker or a stock advisor or something? Like, you have to spend a lot of time with trying to do your due diligence on some of these things. So that was my first question.
Well, so to address your first question, I think it goes back, Lana, to part of what I just said previously, which is you have to get yourself introduced to trusted professionals that maybe other people know, that can help you wind your way through what it is that you're looking for. So if you are looking for, a tax accountant for US or foreign tax advice or whatever, well, maybe, you talk to Nader, and then you ask someone else for another tax accountant to talk to get their opinion and thought, so that you're getting thoughts from different people. If you want private equities, maybe you ask Huong, you say, Huong, who do you know that deals in private equities? And Keith, who do you know that deals in private equities, so I can talk to them? That's
right,
how.
But Keith, I think her question was, okay, well, if you've got these 2 individuals and both of them give you advice that's contrary to each other, how do you decipher that?
And you ask more questions.
Exactly. Exact answer.
Ask more questions. Then you have to go back to them and ask why. You have to ask why. Just keep asking why until you run out of whys.
And if I may cut in, sorry, go ahead. Now you see, 3 days ago, Epic Alliance declared bankruptcy. So, and I was reading, so I never heard of them, and I was reading about it all through these articles, and I was getting, so, I mean, when they were selling these investments to people, they were showing all the forecasted numbers or what would have been. But did anybody ask them, how many properties do you have? What I was reading was that they owned 400 properties, but half of them were empty. And out of those 400, all 400 needed they were in dire situation for repairs. Did anybody ask them that? So when you are researching it, what they just tell you isn't necessarily good enough and 100% accurate. Everybody, yes, of course, they put a perfectly beautiful picture on what they are selling. Got to get deeper, got to ask the second question, ask the third question, fourth question. research it as much as you can and ask as many questions to get to the bottom of it. When I was reading the articles, and that's why Saskatchewan Securities Commission is investigating this as a crime that has been happening, because it's not just that they went bankrupt because they were fooling people. So you got to watch out for yourself. You got to research it yourself. You got to read it everywhere. Anybody coming to you and with a good investment, question them, question their background. Ask for audited financial statements. I know if they are a small company, they may not have audited financial statement, but at least ask for financial statement. Don't just blindly give your money just because you need to invest or just because you need to diversify. You got to do your homework.
Wait,
If it sounds too good to be true, it probably.
True.
And you have to, and if you've got two people that give you contrary information, then you go and find a third.
Yeah.
Get there to see what they say. And that's the biggest problem is a lot of times people make their decision based on fear. And they've got a fear of missing out, right? And that's what it doesn't matter where the advertising is, doesn't matter if it's on Facebook, wherever it is. It's based on trying to get you to get that FOMO. And you have to be able to overcome that FOMO and fear for yourself. So, and be aware of that. What is it that's even driving me towards considering this investment? And then number two, what do I have to be careful of?
yeah, I agree, like fear. And if you're not a risk taker, so then you sit on cash for a long time because you haven't made up your mind on what you're going to invest in. And by the time you do, it could be too late, right? So thank you. My second question was, as a senior, what suggestions for investments do you have in the future? And like Huong said, like the way, like I started investing 20, 30 years ago, it was stocks and real estate. And, there's a lot of more sophisticated investments now that you can do that are a little bit easier. But, everybody tries to catch the dollar going up or whatever. And, they want it to happen faster. So, how do you protect yourself as a senior now when you've got that money, but then, it's kind of risky too, what you get into these days and for how long?
Well, where do you want to live when you retire, Lona?
Kihei.
Yes, absolutely. So, well, maybe but you know what? Why not invest in where you want to live when you retire?
Yeah.
Well,
Right?
I'm in Alberta, so that's a start, I guess.
Right. But that's the thing. Like if you see yourself going, well, when I retire, I'll retire to a senior's home in Victoria. Well, find out who the company is that owns the seniors homes in Victoria, or one that, if you've got an idea, and invest in that company. If it all makes sense, right? And if that's where you think that your retirement is going to be. Like there's different ways you can look at it and consider it. But that's one way to look at it. If that one of the private equities that we own is in seniors housing. Now that wasn't a choice because of that's where we want to retire, but looking at our population and what the need and desire is, there's a need and desire for seniors facilities to continue to be expanded, which became even more bigger story during COVID than anyone ever realized. But and it's kind of fallen off now, but that's forever going to be a problem that we have. Does that help, Lona?
Yes, I guess that's like anything else. You have to kind of change your mindset, on things differently, since everything is changing these days, right?
Mm.
Thank you.
That's good. So that actually took out my questions around Epic and how to protect against companies like that. So that's really good. And it's interesting because if you read the articles on what they were promising people, it wasn't outrageous what they were promising people, right? It wasn't like it was too good to be true. right? It's just that they weren't able to sustain the rental market and the flip market out in that area. So, okay, so let me go to, thank you, Lana. Okay, let me go to the next question here. I did see something here. And I don't think you guys can all see it. So Gui, I think I said that right. Can you unmute yourself and you can ask your question? I'm not seeing you. I'm probably saying your name wrong too. All right. Oh, I found you. Okay, Guru Singh. I am liking you to speak. There you go.
Yeah, hi all. So
Hi.
am I audible? Yeah, my question is more in context of assignment sale. So I read like on assignment sale, we need to pay, like it's 100% considered as business income and we need to pay 13% of HST on profit plus deposit. So my question is there any way like we can show intention as primary and we can avoid 13% and we can say it's capital gain if it's before closing?
Sorry, no. It's just one word, straightforward. No, there is no way out of it. CRA sees this, and they have been looking at this forever as business income, as a flip, that you had the intention of profit. And with more and more people getting into real estate and real estate market being extremely hot, they have expanded the audit division enormously. 4 years ago, they invested $1 billion in CRA audit divisions, and they went after real estate people. And this is exactly what they are after. And now they have access to all the what do they call it? Land transfer, sales, deeds, offices all across the country. So they know what is getting sold. So unfortunately, there is no way out of it. If you want it to be capital gains, it has to be at least 1 year you owned it and you lived in it or you had rented it out. Because even if you own it, and I have examples of people that have owned real estate property less than a year, and CRA came after them and said, no, this is business. And as a business, only the first $30,000 that you make in the last 4 rolling quarters is not subject to HST. But I don't know any property in this country that is less than 30,000. So immediately they put a sticker on it that this is a business sale. It's subject to, depending on which province you live in, it's either 5% GST in Alberta or 15% in Nova Scotia. And then the capital gains, there is no such thing as capital gains. They tax it at 100%. So whether before you own it or you own it even less than a year, no, sorry. They are going after this type of transactions and they are auditing them. And I see every single year, I see more and more people coming in or calling me and asking me that, oh, CRA is taxing me for HST and I don't know why. I sold my home. I sold my investment property. Yeah, but how long did you own it? Oh, I bought it and then I turned it around and I sold it. So that's that's not an investment in the eyes of the CRA. This is business. So no, and assignments, exact same thing. Sorry. You got to live in it for a year to become a principal resident.
But this is the case even if somebody is doing first investment property, like if
doesn't matter, you got to live in it. You either live in it for a year to become principal resident, or you rent it out for a year to become an investment property.
But before
the
closing
intention to CRA is profit, and therefore you profited in the short term, and that's business. They don't accept it, unfortunately. You and I can argue all we want. Actually, I was giving an example to somebody else yesterday, no, the day before yesterday, we were talking, and when I opened my own office, I retook all my tax courses because I had taken them, I don't know, 15, 20 years before that. And my own teachers' parents were being audited by CRA. And the situation was that the parents, the father got retired. They sold a principal resident. It was huge for them, few bedrooms, few bathrooms. They wanted to travel. They want to go see the kids, the grandkids. They move into a condo. Half of their belongings are in the storage room in the condo building. The other half are the fancy stuff are in a storage room outside that they rented. After 8-9 months, they change their mind. It's not comfortable. Every time we have a guest, we got to go to the storage room to get the China dishes. They put it up for sale. They sell it, and bang, it's 10th month. 2 years later, CRA comes and sends them a bill for HST and wipes out the capital gains, and charges them not capital gains, business taxes, and stamps it as a business sale. They lived in it, they changed the addresses, they changed phone number. No matter how many times they explained to CRA that their intention was to live in that condo, CRA didn't accept. They moved in, they changed the address, they registered with all the utility companies. CRA didn't accept it. They appealed it. The appeal division rejected it. And that takes at least a year to go through it. And then they're going to hire a lawyer to go to fight it at court. I never kept touch with the teacher, but I can guarantee you they lost. CRA doesn't accept it. They lived in that house for less than a year. In 8 months, they put it up for sale. By the end of 10th month, they moved out. CRA stamped it as business sale, 13% HST and 100% of the gains taxable. They don't accept it. Unfortunately, they lived in it. So there is no way for an assignment sale to be sold as a principal resident or intention of principal resident. You got to live
in that case. So in that case,
Okay, so let me ask the next question, and then Josh, I see your hand up. So let me ask this question first, and then we'll have Josh ask his question. What has been your investment strategy or strategies until now? And how will that be changing in light of all the economic, geopolitical issues going on?
Not changing anything. I'm still looking at real estate, looking for cash flowing real estate. And that's generally my model, is looking for opportunities for cash flowing real estate. So whether that means maybe if it is a property under value that can be renovated, re-tenanted, and produce cash flow, then that's the right kind of property. If it's private equities, I've got those private equities. I'm not looking to change what I've got in the private equities or in what I do for self-directed investing out of Olympia Trust or any of that. That's where people get themselves into trouble, is when they think they all of a sudden need to make a big shift. And big shifts are not always necessary when things change economically. Now, if you are overly exposed in something, well, then, that's where you need a conversation with Joel to talk about what are the risks that based on how you've exposed yourself. But if you've done your homework properly ahead of time, you should not feel like you need to make drastic moves when things change. And often, sometimes I've said that before, it's out of fear, right? You don't make decisions out of fear. And because, the stocks are like real estate. Yeah, your stocks go down or your real estate value may go down. You only capture that down if you sell at the time when it's down. So if it was good for you when you bought it, and it was good for you when it was up, why all of a sudden is it not good for you if it's gone down? Now, if the company's at risk of going bankrupt and it going further south, well, you gotta know, you've got to do your research to know whether that's what the time. But that you got to be careful when you make if you make rash decisions.
So I have a belief that real estate in many ways is one of the easier investment classes to learn and understand and succeed with if you're careful and cautious in the beginning, but especially because there are so many professionals who are experienced. If you think about it, everybody lives in a home, and many of us have another piece of property of one kind or another, vacation home, or we've made an investment purchase. And it's something that is done all over the world and by every class of people, is to attempt to buy some real estate, gradually pay off your debt, help the neighborhood get better, improve the house, make some money and sell it, and then take the money and go do the next thing. And unlike a lot of sectors out there right now that you can choose to go into because you read headlines about them and you see people making a lot of quick money, real estate has a long history, a lot of expertise and experience that people have. And if you're smart about that side of it and don't just get caught in somebody's, I guess, hype, and you do the basics, and you have people that actually can help you look over documents and learn what's in those documents and what it all means, you can become, it's a pretty accessible business or investment strategy. That's my experience. And then as you do it, you keep learning more nuances and tricks of the trade, and prices over time, population growth and the growth of places where you've got real estate become a bit of a trend line that you may not make as much as the next person or sell at exactly the right time, but they tend to build value because there's not room for endless amounts of real estate ultimately. And so it's a pretty good way to start in business.
My philosophy has always been.
Go ahead, Nader.
Sorry.
No, go ahead, sir.
Sorry. My philosophy has always been be a long-term investor, whether when I was a student and I started with $25 monthly drip plans with Chevron, Texaco, and ExxonMobil. I started with that, and it was long-term investments always in my mind. And when it came to crash of 2008, I couldn't care less because I was buying for 20 some years the stocks. And real estate, the same thing. Once I got into real estate, you got to have that. I have that long-term view of the investment. Thank God for stocks. For real estate, there is no newspaper putting the daily prices, but like Warren Buffett said, people buy real estate and they forget about it, but they buy stock and they check the price the next day. So it shouldn't be like that. Who cares how much the stock is? You got to have one strategy, and somebody coming to you with a new idea or market crashes, it shouldn't impact you. If you have a long-term strategy, if you know what you're doing, stick with it.
Yeah, I mean, I see many names I'm familiar with here that are joining us today, and understanding economic fundamentals behind any choice of investment is crucial. Whether it's real estate or whether it's a private equity or whether it's a stock company you're going to invest in, that's so critical to know and understand. So, be cognizant of that, but then be aware of influences. We've got a shortage of housing as it is, and now we're bringing in. We're looking to bring in more immigrants from Afghanistan, more immigrants from now Ukraine, and then plus the immigrants that we had planned to come in from other countries over and above that. I mean, we're, as far as the federal government looks at it, because of COVID, we're like 300,000 people behind the eight ball on immigration, because that's what they had projected for 2020 and 2021 is an additional 300,000 immigrants to Canada. And so they're also trying to find ways, how can they make up that shortfall? But in some ways, maybe that shortfall is going to help us as a country as a whole. Maybe there's going to be the ability to have more supply and housing brought on to help not have so much pressure on things such as rents because of a shortage of rental units in places like Toronto and Vancouver and maybe Calgary and Edmonton. Or are these people, when they come, going to be more influenced to go to where the rents are lower, such as maybe a Calgary or Edmonton, or a Saskatoon, Regina, Winnipeg, places like that. What's going to influence their decision as to where they immigrate to? Some of it will be cultural, some of it may be economical.
So Josh, your hand went down, so I don't know if you still have a question or not. So if you do have one, feel free to unmute yourself. Otherwise, I will ask my next question here, which is, when you talk about taking risk, and usually we talk about time, money, what other type of risk considerations do you look at? Or is it just those two?
Capacity. How much can you handle? Do you have the team, i.e. the advisors or the contractor that you need to take care of the property after you buy it? There's always I think there's always a team involved. And the other thing you need is a judgment about where the trends are going. You can watch neighborhoods and you can see where you can base it on where the less costly properties, where are people moving to more heavily. I'm sitting in Vancouver right now on the east side looking back at the downtown, and the last years of the political climate in the US sent many additional immigrants that were highly educated and trained into the tech sector and other sectors in Canada, which has created a very serious building boom in the downtowns across the country, or it's helped it. And watching these trend lines and stepping into their flow on the earlier side is a really good way to think about the larger context instead of just a house at a time or a commercial building at a time. So I think the cities are prospering because Canada has a policy to bring more people. And that's helpful to everybody commercially.
Linda put in the chat liquidity. So I think that's a good one to look at as well, as how liquid you are or how quickly you can get access to that cash if you need it, right? So when we talk about risk, is there anything else that you guys want to add to that?
Research. I think it reflects back on things that we said earlier, and that is you've got to do your research. And no matter what the investment is that you're choosing, research is key. Research.
Okay, so that brings so that brings me up to one of my questions. So somebody recently came to me and said, "Hey, Huong, you know what? I've got about $400,000. I don't have the time or the energy to do any due diligence, but I want to consistently make 15+% on that money."
Okay.
So what advice would you give to somebody like that?
You need to find the right trusted professional to work with to help them to achieve that. Like they want to make 15%. Okay, well, how do you want to make 15%? Do you want to lend that money out? Do you want to invest it
in business?
Buy a business? Do you want how do you want to make that 15%? That's the first question is how, and the other question is why and by when and by how and how much. Like, do you want 15% of a year for the next 20 years, or are you looking? Is there some short-term thing that you need to have 15% a year for 5 years? Like, there's so many. Often the biggest problem is that there's not enough questions asked. Not just enough questions, but the right questions aren't asked. Asking lots of questions is one thing, but asking the right questions is another.
I have a question. What do you mean by no due diligence? I mean, if you don't do your due diligence and you don't do your homework, how can you invest 450 with anybody? I mean, you're wanted for some scam investor to scam you.
Right. So they just wanted to pass that work onto somebody else.
You got to have an enormous, so we go back to what Keith said in the beginning, you got to have your team to trust them with it. You got to have your real estate agent, your financial advisor, your accountant, your lawyer to do that for you. If you don't want to do it yourself.
Yeah.
Because without due diligence, unless you're really seriously rich and you have millions and you have a huge team, I really don't see for a small investor to do it without due diligence.
Yeah. Joel, I see you giggling there.
Yeah, these are very important common sense pieces of advice.
All right.
Unfortunately, what people who are trusted professionals and trained professionals, what we see as common sense, unfortunately, there's the uneducated that don't understand or realize what that what it means to use common sense to make those choices. They think that it's just, yeah, this person says they can do it. Here's the money, make it happen. And then when it doesn't happen, unfortunately, they're the person interviewed on the news going, well, they said they could do it, but now I can't get my money back. And they say my money's gone. Like, I lost $400,000. And you know, and then they're unfortunately the sob story that's on the 6 o'clock news.
So let me ask you guys a question about common sense, because we've used that phrase a few times now. So the common sense investing principles that we've used up until now may not be valid anymore, right? So what is one common sense investing principle that you would still suggest that we either learn to bring on into our surroundings, or one that we should be keeping to make sure that we still do?
In real estate, buy for cash flow.
Nader, do you have one?
In the beginning, Bill, go ahead.
Go ahead.
In the beginning, build slowly. Learn your way in and take time to pay attention. Don't try to do it all at once. There's lots to learn.
Nice.
Analysis, research, don't give that up.
Nice.
If it comes down to one word to me as an accountant, is research and analysis. Two words, sorry. Sorry. Don't give that up. Whether it's a real estate and its cash flows, or capital gains, or whether it's stocks, research it. Mutual funds, or financial advisors, research it.
Okay.
Is that specialized accounting down to one word, but say two? Is that?
Yes.
You give more value than what you actually say, right? Because you're doubling up there. Okay.
Thank you.
So let me ask a question about Epic now. So if we're in real estate and we're working with JV partners, okay, how can we address our current JV partners to reassure them to say, hey, you know what, my business model, the way I run my properties and all that stuff is not like that company that folded? How? So the ones of us who are still working here with our portfolio, what can we do to reassure our current partners and future partners coming on board about doing real estate deals?
You've got to take the time to be okay with answering their questions and being able to work through the emotion of the fear that they have, so that you can build that trust. Because without trust and without being able to understand and address their fears and accept their fears, how can you move forward and help them to move forward? Because fear will get in the way of them. The fear will get in the way of themselves building their wealth for the future by somebody not taking the time to listen to what their fears are, acknowledging what their fears are, and then helping to then show how they, as the investor, help to minimize and alleviate those risks that are expressed through their fears.
I say, again, looking at it as an accountant and somebody who is doing financial analysis and rental analysis daily, first of all, as an investor, you got to ask the second layer, third layer, fourth layer of questions. Don't give up. Ask for, and as somebody who wants to bring in investors, be honest with them. If you can, provide your financial statements to them. Large investors, they do not get into investments before having either audited financial statements or a notice to reader prepared by an accountant like me. I have been small investor who was asking for financial statement with notice to reader, and the guy that we just did 10 years, we were doing tax returns for him, and he was bringing an investor because he was buying a couple of trucks. Then we had to do notice to reader and then put notes to the financial statements. What are the assets? What are the loans? How much asset net worth is everything? So ask for it. Be honest and provide it to your investors to bring them in. But large investors do not go in just blindly. They ask for audited financial statements. They ask for notice to readers. So ask for those and make wise decisions.
No, and on my screen here, I see just one group of names, and someone here who I know that's here that builds trust with their investing partners and asks great questions is Zoria Belanger, who's here. And so, I've known Zoria and Patrick for many years, but I know that that's how they've been able to build the real estate portfolio they're building in multifamily, is by being able to not ask great questions of their investors so that they can make sure that they're addressing that stuff up front for their investor clients. And Zoe, I don't know if you can unmute yourself, but if you want to comment towards that, that'd be great. Zoya has like 3 little babies, so she could be running around chasing kids at the same time. So.
Okay.
I am here. I was not near my computer. I was just listening, but I did hear that. Thank you, Keith. Yeah, absolutely. I think because I think that a lot of the discussion has been around how, as like more of a passive investor, how you do due diligence, but it's really important on the other side, if you are the one operating, the real estate business, to do due diligence on your partners, the passive investors, and almost we kind of do some of the due diligence for them, because some people don't even know what to ask, right? So if you are the working partner, literally just provide the information, be upfront, and just provide it to them. Like I have this, when we started, we got this like questionnaire of what each partner should be asking the other partner to do your due diligence, and we just provide that filled out already. So yeah, but thanks for mentioning that.
Good idea.
Okay. All right, so let me ask the next question here. What does a real estate crash look like to you?
Crash, so it would be the 2008 crash of United States, that everything dropped by 50%. To me, that's a crash. But have we had any other crashes like that? Not in recent history, going back to 1920s, 30s. So that's a crash. Everything else to me has been either a correction or drop, something like that, 10%, 20%, that's it. Recessions, 20%, but not, crash would be the 2008 crash of United States.
Yeah, and
that's my opinion. Sorry, go ahead.
And how a person feels or defines a crash
exactly
is, I think, goes back to something I said earlier, is it's defined as to whether you choose to sell at that point, or if you've still got good cash flow coming in from your property, you go, yeah, price doesn't matter, I still got cash flow. So here's the great thing about real estate is, you buy a property for $400,000, you put $80,000 in, and your tenants pay off your mortgage. In 20 years, if that property's still worth $400,000 because it went up to $500,000 and then came back down 20%, you still made 500% on your money, because now the tenants paid off $320,000 worth of mortgage for you that didn't pocket. So, so that's all relative to how you react when things like that happen. That's for me why cash flow is king. Cash flow is the game. And if you've got cash flow, if you've got cash flow and you've got people paying your mortgage and your expenses with cash flow and it's all covered, you really need to worry about the value going up and down and stuff. If you're starting to plan an exit strategy, well, that exit strategy plan should start probably with the realm of a 5-year plan. And that's because typically most mortgages are a 5-year plan or a 5-year term. And now if you've got a different term on your mortgage for some reason or whatever, you've got it before you decide to renew a term or whatever. If you're planning an exit strategy, there's a whole other bunch of considerations that you take before you sign your renewal.
And may I add something? Don't be scared of crash. Crash is where the opportunities come up. You buy things 20, 30, 50% discounts. I mean, that's the time to find the best deals. I mean, when the crash of 2008 came, I was working for Cummins, and Cummins is a large engine and power generator manufacturer. They put their engines into the trains and yachts and anything from Dodge Ram and Nissan Titan all the way to huge yachts and boats and trains, locomotives. And the stock went from 120 to 20. So everybody was crying, but sorry, to be honest, I was laughing because I bought the stock that I couldn't afford to buy 100 of it for 12,000 US dollars. I bought it for 2,000 US dollars. So crashes have a positive side too. Yes, on one hand, your value, if you're in there long term, it shouldn't matter. It's going to be just a blip on a paper. 20 years later, down the road, you sell it for a profit. But at the same time, look at the positive side. You always have opportunities coming your way. You're muted, Keith. Keith, you're muted.
I think you might. Okay, there we go.
Okay.
Thanks. Click the wrong button.
So one of the changes that is happening in the US is allowing adding the sophisticated investor into the pool of investing opportunities. How will that affect Canada?
We already have a lot of those rules through our Securities Commission in place in Canada, or for investing in Canada anyways. So, like in Alberta, there's limitations if you're going to have more than 3 investors on any one deal. Now you start getting into 3 or 4 investors on any one deal. You start getting into security commissions requirements and stuff. So a lot of that stuff already exists in Canada. As far as the US making changes, it's a matter of what type of investing are you doing in the US, what is your methodology, and how is it going to impact your business? Which side of the coin are you on in relation to that? Are you the person trying to get investors, or are you the person trying to be the investor? And what you need to know depends on which side of the coin you're going to be on. I think we saw Olympia Trust take a step at the beginning of March with the changes that they put into place Canada-wide for situations where there's going to be 2 or more investors in a mortgage on any one property, or if there's a relationship between a mortgage broker and the borrower, and they're getting money from Olympia Trust, where there's specific requirements. So, those types of things are changing here already. So what's happening in the US, and what that means, we'll see. Canada is a safe haven for money laundering and mortgage fraud, unfortunately. And places like Toronto and Vancouver and the property values there feed into that. And so the government is seeing that. Olympia Trust saw that. Epic Alliance may have been part of what Olympia Trust saw as far as rule changes they made first in Ontario. But that, a change like Olympia Trust made has an impact and causes that need for additional due diligence, or in this case, mortgage administration, and making sure that, there's further risk reduction for people with their money.
Yeah, that question came about because one of my coachees brought that up as a concern of theirs, right? Because they do raise funds with accredited investors. So I'm not going to ask the next one or that one. Okay, so I do have one that I do want to ask. So this one is, if the rumors that we are not allowed to use our HELOCs to make investments anymore, if that comes true, how will this affect investors?
Can one of you describe what a HELOC is?
It's a home equity line of credit.
Oh, I see. Okay.
Is there a rumor? I hadn't heard of it.
Yeah,
It's a rumor. I didn't start it. I'm just hearing it.
you know what? Investors are resilient, and with the proper guidance, working with a mortgage broker, they'll know how to pivot. And all that means is you're going to have to do some better pre-planning. You're going to have to take the money out of the HELOC, put it into a savings account so that it's there for 90 days so it can mature, and then you can use it for the down payment.
Yeah.
I mean, it's not a lot of rocket science, but it takes the guidance of the right professionals to make sure you can continue to grow by understanding what the needs are.
How do you pick the right professionals?
You guys answered that one already.
You did? Okay.
Or how do you pick the
You wanna
right,
answer?
how do you pick the right professionals? Is that what you asked, Joe?
Yeah. Yeah.
You got to ask the right questions when you talk to them and find out what they willing to share.
And get references.
You know, what's their own vision and calling? Are they there? Whose side are they on?
Okay. So the next question is, we've been living with low rates for the 20 plus years, and many of us don't remember having mortgage rates at 15+%. What advice do you have for investors who will have mortgages coming up for renewal in 3 to 5 years, who will potentially be seeing a higher interest rate than what we've been used to?
So number one is, if you bought for cash flow, you have built in some cushion for yourself. Number two is, when you qualified for your mortgage, you had to qualify based on a benchmark rate. If you got, now pretty much all mortgages are past 2016 when they started. There might be some, but most of them at that point, you're already qualified at a benchmark rate of somewhere around 5 or 5.25% when you got your mortgage. So there's some cushion that was already built into your ability to handle a higher amount of mortgage interest debt because of that. Now, if you've gone and taken on other additional unsecured debts and expenses outside of that, or you've lost income, those are things obviously can be factors, but sometimes it means pivoting and changing. And, if you're normally a fixed rate person, maybe you've got to pivot to a variable rate. If you're normally a variable rate, maybe you've got to pivot to a shorter term fixed rate to make sure that your property still does cash flow. We've, over the past 19 years that we've invested, we've done that, where we've pivoted. Typically, I'm a multifamily. I'm a variable rate mortgage kind of guy, but there's been periods of time in the last 19 years where the variable rate wasn't as good or as aggressive as what we were going to be able to get as a fixed rate on a shorter term that fit the guidelines. Like we typically look at US election cycles and often try to match up our terms with US election cycles, because often we see mortgage rates drop in the period of about 4 to 6 months prior to a US election. And then they go up, they take a bit of a sharper incline right after. Now, things have changed in the world and in our economy. Will that be the same for the next election in 2024? It depends on what happens in the next year and a half.
Getting harder to predict.
Yes.
Too many factors in play right now.
So Karina, you have a question. So can you ask your own question, please?
Hi, everyone. So we mentioned if you pull the money out of the HELOC and put it into savings account and a bank account, well, I know that the bank flags anything over 50,000 that goes into your account. So will that be seen as income if you put it there to invest it after the 90 days?
So
No.
this is where, when you move, this is where I'm going to bring my Smith maneuver professional information into the conversation here. And if you move money from the HELOC into a savings account, you automatically trigger the tax deductibility of the interest on the money you're paying in the HELOC, because you're putting it in an account where the intent is to earn investment income, because a savings account should pay you interest this much. I can't make my finger that small so you can see it. So is it income? No. Is it a large deposit? Yes. The reason we wait 90 days and we don't pull the statements until day 91 is because then that large deposit for the banks, when they're looking at your down payment, they do not see the large deposit having happened 90 days previous. They see that there was money in the account as of day 91, and for the period, for the 3 months of that, make up that. So as far as it being treated as active income, it's not active income. You took it on as debt. You have proof of where the money came from as a debt. You put it into here. There's not, you might earn some, you might get a small tax slip for some interest earned on that money at the end of the year that you have to declare, but you'll also have the interest to declare against that. So it's not income, is it, Nader?
No, it isn't. Absolutely not. People as individuals, as corporations, constantly move around money, and loan, that's a loan. Either loan from one pocket to the other or loan from shareholder to the investor. So no, that's absolutely, so I never even heard of anybody discussing to change it or suggesting to change it. No, it's not, absolutely not.
And if you have an accountant that's telling you that it is, then
Absolutely wrong.
there's a
Change your
bigger problem.
accountant. No, because there is not even discussions. I mean, yes, there is a lot of discussions about, how to fix the real estate and the prices, and maybe principal resident. Next week, we're going to see in the budget if after 3 years, finally principal resident becomes taxable or not. But this been there for 3, 5, 6 years since CRA started asking the question on the first page of the tax return. Have you sold the property? Have you sold your principal resident? So that is, everybody knows why CRA asking for it, but that's been there for 5, 6 years. And we will see on the next budget if it is in there or not. But I haven't even heard of this one. No, it's absolutely not. If somebody's telling you, it's wrong.
And just one last question: the interest that you paid for the 90,000 is only for the Smith maneuver is only for the 90 or 91 days, correct? Like the amount of time.
Yes.
It's for as long as you have that money into an investment. So if you move it from so let's say you move it into the savings account and then you take it and use it for a down payment on an investment property. That's still for the intent to earn investment income. So the interest on that 90,000 that you took out of your HELOC or your 100,000, the interest on it is still 100% tax deductible.
Okay, perfect. Thank you very much.
And anyone here, if you want to have a conversation around the Smith maneuver and how to set it up for yourself, you can certainly reach out to me and we can have that conversation.
So I will put Keith's and Nader's information in the chat so that you guys can contact them outside of this session. So thank you for that, Karina. Ryan, you have a question as well. So why don't you ask your question while I put that info in.
Hello, gentlemen. Thank you very much for all the valuable information you guys are providing. Thank you for sharing your knowledge. I just had a question regarding, so if you guys could start all over again and you lose all your contacts, but not all your knowledge, where would you begin? What would you start off at? Considering right now, there also is a rumor, that they're going to be increasing the deposit for investment properties or investments. They're going to be increasing that up to above 30%. I don't know if you guys have heard of that, if you've heard any credence to that, but supposedly there's consideration that they might be increasing that down payment percentage to upwards of 30% to curb the zealous investors. And yeah, so it's kind of like a two-part question.
Protect people from themselves.
Yeah. So I've heard that rumor. I mean, the budget will tell. However, it doesn't change, doing that doesn't change affordability of homes for people that are trying to buy a primary home. That doesn't, the only thing that will change the affordability is supply. And when you have, you know, places like Toronto and Vancouver that just have a lack of supply, Vancouver, somewhat the supply is because of a restriction of just how far they can expand. They can only go up, they can't go out. So that's part of the problem there. Toronto, part of the problem is that they just have not approved enough development to allow for supply to increase. So that's part of the problem there, in outside of just building condos, right? And that, you know, so that single family housing supply. Again, investors are resilient. The government makes changes, investors pivot, they find a way to make it work. And that'll happen here. So investors will go, oh, okay, well, I guess I need to buy a primary home and turn it into an investment property in a year, and then go buy a new primary home, and I'm going to have to build my portfolio that way. So they'll just find a way to pivot, right? Or they'll go, or investors or people will, you know, that have existing investment properties will be more likely to bring joint venture partners in on properties they already own, and people invest in property that way. And those people that bring those joint venture partners in, they'll build up that 35% in a different way, and they'll go buy more properties. So as much as rules can change, there's always ways that people are going to find another way to make it happen. People who invest tend to be more resilient and have more creativity in their mind. And if they're working with the right professionals that have that creativity in their mind as well, then there's ways to make it work and to find a way to still make it happen.
Okay, so just a time check, we are at the hour and a half. And I know that I promised you guys that this session would only be an hour and a half, and with the bonus 30 minutes. So I want to be respectful of your time, because I know that if you have other commitments, then I won't be offended if you have to take off. But I did want to share this last stuff with you, because we promised that we would not sell anything on this session, and we're not. But what I'd like to share with you is some of the gifts that we're giving as part of the attendance for today. So myself and Nader, we have books that we will be sending you, ebook versions. And Keith, I understand you have a book coming up as well?
I do, and actually I do believe I've got it available. I'll get the link and I'll post it in the chat.
Okay, perfect. And I know that both of you also offer complimentary calls as well, so that if somebody had some question that is a little bit more tailored to their situation, that you guys would be able to give them a free consult.
Yes.
Yes, okay. Nader, I'm putting that in there for you too.
Yes.
Because you've always done that for me, so I just figured that you were doing that for everybody.
Yes.
Okay, awesome. Awesome. So now I will stay on for another 30 minutes, and I know that some of you will also like to stay on as well.
Yes.
And ask some more questions. I still have like 10 more questions to ask. Okay. So I will keep asking them.
Before everybody leaves, I like to take, because we discussed this about the US investments and you didn't ask, nobody asked about it. I like to take a couple of minutes of everybody's time, and as an accountant, give you some piece of advice for free. If you guys don't mind, if you're still staying around.
Okay, go for it, Nader.
So for the US investments, is a bit different than just buying a property here. You go and buy it in any Canadian provinces, because rules are quite different. And doing it in US legally and properly is different than the way we do it in Canada. And with properties going up every year, especially last couple of years, I have a lot of US investors coming in, Canadian investors that are buying in US. So there is a right way and there is an absolutely wrong way to do it. A lot of you are buying in your own names, and that's absolutely wrong. Because when you buy in your own names, there are two things that you got to consider. One is the protection. There are a lot more lawsuits in US, especially when it comes to real estate deals and when you sell it. And then is the question of tax. So when you buy a property in the States, it becomes part of your income. So all of you who are investing in the States and you're making 100, 150, 200 grand, you're paying 36 to 40% to 46% tax on that in Canada. So that is not quite beneficial. I mean, it wipes up all your profits and wipes out all the investments and defeats the purpose of going to the United States. And then God forbid, when you sell it, if you get sued, I have a doctor client and he says every time he sold a property in the States with no exception, 100%, he has been sued except one time in his 30, 40 years of investing in the United States. And that's the time he sold a piece of land to a Chrysler dealer because they were buying the land behind the dealership to expand the building and the parking lot. But all other deals, he has been sued. So buying it in your name is wrong. Be careful if you're doing it because it's easier, because it's cheaper. Second wrong way is buying it through an S corporation. We don't have S equivalent of S corporation in Canada. S corporations in US is a flow-through entity. That means the money flows from the corporation to you. So the only thing corporation does is to provide that protection for you that you don't have as an individual. So when they sue the corporation, you're not personally at risk. But the taxes, the income are all flowed to you, and therefore you pay the tax again personally. So you want to set it up right. You need to set up a complex structure in the States in order to make sure you pay the lower taxes and it doesn't come back to Canada to pay the higher taxes and to protect yourself. So you need either a partnership, LLC, you need to bring in a lawyer and do the proper structures, create either a partnership and a corporation or two corporations there. Yes, it costs money, but just think about it. I have a client, he's a small investor, he has 4 properties, and each property makes him about a couple of $100 per month. So that's $2,400 per year, 4 of them about $10,000. He makes about $100,000 a year. When we do his taxes, he's paying $3,600 minimum on that $10,000 profit. 3,600 US, that's $5,000 Canadian that he's paying tax on that. And when I asked him, why do you do it this way? Oh, it's expensive to bring in lawyers and create a corporation. And when I sat down and did the numbers, how much taxes he would have to pay now that he has 4 properties in United States, then he realizes what a mistake he made. So if you're getting in there long-term, think of it as a long-term investor and set yourself up right. Yes, you will pay a little bit more every year. You will pay a little bit more in the beginning, but then you're set for life in order to pay lower taxes and be protected. So be careful. A lot more clients I'm getting every year who are investing in the States, more than before because of the prices are crazy here in Ontario. So, and in BC, so everybody's going down south purchasing properties. So make sure you do your numbers before you buy and talk to a lawyer how much it costs to set up a proper, or to an accountant who's dealing with US investors, and pay a little bit extra, but protect yourselves. That's it.
So that brings me up to my next question, Nader. Okay, and I'll ask this for Joe and Keith to chime in as well. What are your thoughts about investing in my back door? And is that stronger now, and why?
In my back door?
Like I'm only investing in Ontario, I'm only investing in Alberta, or I'm only investing in Canada.
No, I'm more and more my clients are going to Nova Scotia, I'm going to States and Newfoundland. No, they are diversifying. More and more I see diversification. And that's why I had to talk about that, because I see so many of them. I have a client in 4 digits. I'm 4 digits, what do you mean? 4th tax bracket, 46%, and he bought a property, enormous property, is paying 46% tax because it's simpler, it's easier. So be careful. I mean, no, I see a lot of people going down south and going east because of the current situation here in Canada.
Yeah, I'm seeing a lot of people going down to the US because of cash flow. Like you could buy a property in Detroit for 100,000, right? Whereas you can't really do that in Canada now.
No.
Joel, did you have a comment about the backdoor strategy?
Well, I've always concentrated in geographical areas, even neighborhoods. And the rationale is that you get to know an area very well, and you understand the pricing and the trends that are going on there, and you can talk to the city and find out what their plans are and things getting improved and what's happened. You got a lot of information you can gather. You get a lot more familiarity. You find out who's who, and so there's a truism there that focusing on what you know is a good way to know more and be smarter about it and do better with it. And then you want some diversification, and you can take what you've learned focused on a certain geography, and then look for similar geographies with similar patterns about where population is going, what's the look of the commercial and retail entities that are showing up in that neighborhood, what kind of people are showing up, and that there's a lot of information with paying close attention and understanding trends, and even just spending time walking around an area a lot over time and seeing what happens. Realtors have a lot of information. Title companies have a lot of information, and so there's an argument for both types. But focusing on something that you can become very skillful at, and you know who to ask about what, is a huge advantage, rather than just trying to read the newspapers or listen to people's speculations.
So before I forget, I'm going to launch the end poll. And if you can take a couple of seconds to participate, it's only 2 questions. So please, if you could take the time to answer them, it will help us with some of our planning and some of our future educational segments. So while that one is running, I will ask the next question. Okay, so talking to an investor in the East Coast recently, they told me that they were feeling stuck because the market has changed and they couldn't make the flip strategy work, because that was what they were primarily doing. What suggestions would you give to investors who are in a geographical area and the strategy they were using is not working anymore?
For me, it would all start with a conversation to find out more about what they were doing. What type of properties were they doing flips on? What type of areas? What type? There's a backstory and a history that has to be understood and figured out first. Then start questioning them and challenging them as to what other opportunities could exist where they are. The opportunities can look different based on location. So it's hard to give any specifics here, but it really boils down to being able to have that understanding first of where are they coming from and what have they done, and to say there are times where flips are not necessarily the greatest option, depending on what your parameters are for that you set for a flip. So in Calgary, in Alberta, from 2015 until 2021, flips were very difficult to make profitable because the lift that you could get was fairly limited. However, there were people who built their business models on that, and so they pivoted. And in some cases, they were, instead of taking margins of 30 and 40K, they lowered to keep their crews working. They took margins of only 5 to 10K. So sometimes it's a matter of being able to make a shift in your mind and be okay with it, so that you can make your way through whatever is going on currently and come out the other side.
I got to add to that. So when it comes to investments, and it's large investments, whether you were asking me earlier, you have someone who wants to get into business, or somebody who is now in Nova Scotia and East Coast not working. And when it comes to large investment like this, you always got to have a plan B. You always got to see, what if it doesn't work? What if this flip doesn't work? What if this rental doesn't work? Or what if I get into this business and it's not working the way I wanted it to? So when it comes to these large investments, you always need to have a plan B and have something in the back of your mind ready to switch strategies. And then if we can't do anything, then unfortunately, you just need to be patient. So instead of flip, turn it into hopefully a profitable, positive cash flow rental property, and then sell it later on. And hey, take advantage of the capital gains if you sell it a year later.
All right, so I'm getting into some of these other questions that are not related specifically to real estate, but more about maybe mindset. So if somebody said to you, hey, you were born with a silver spoon and I wasn't, so I can't do blah, 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 okay? What would your response be? And would a silver spoon make a difference in today's climate?
I wasn't born with a silver spoon. I'm a first-generation immigrant, and my first job was delivering flyers in Montreal East End, going up the second floor stairs to deliver the flyers. So no, that wouldn't apply to me. But
Nader, it doesn't apply to me either. But people say that to me. I think people say, because they see me, they see where I am, and they're like, wow, you must have had a silver spoon.
Where we are, it doesn't matter. It doesn't mean where we came from. I mean, so yeah, I have a business. I have a few people working for me, and I have 2 locations, but I mean, you got to tell your story. So it's not silver spoon. It's not always like that. It's the hard work that you put into it. And I mean, CJ status part-time, take if you're doing CA or CJ. At the time I was doing it full-time was 3 years, part-time 6 years. Mine took 8 years because I was working full-time. I mean, so you got to, the persistence, the sticking with it and going your way, no matter how long it takes, that's when it pays off. It's not necessarily, yes, somebody who's where I was 20 years ago, 40 years ago, when I came to this country, the new immigrants that are coming, yes, they are where I was 40 years ago when I came to this country. So it's just the hard work. It's just sticking with it and getting up every day and kicking at it. So otherwise, no, you wouldn't. I don't know. I don't know what to say.
All right,
You don't
Keith, how about
succeed
you?
if you don't do it.
Yeah, you know what? It's so part of it comes. So there's one is being able to understand what you yourself were born out of. There's people who maybe were born with a silver spoon, but they've got their own ghosts in the closet that come up for them. And I mean, we've all seen stories of people who we saw as having a silver spoon, and we've seen those crashes. We've seen them do things that destroy their career, destroy their image, whatever. And, you know, and people saw them as having a silver spoon. A silver spoon really means nothing if somebody doesn't know how to properly use it. So, you know, it's all about understanding, getting to know and understand oneself and what your thrownness is, what you were born out of, what did you grow up around, what did you hear, and being able to then understand how that is impacting currently the choices and decisions you're making moving forward in your life that are good, bad, or not. So, you know, we all have 3 keepers. We have fear, ego, and judgment. And so those are developed in us when we're young, right? Oh, careful. Don't go too high, Johnny. Oh, Susie, you know, don't hang your feet off the end of the deck, whatever it is, right? Our parents say these things without knowing that they're building certain levels of fear with us. And we do it to our own kids too, without, right? Rather than saying, oh, good job, look at how high you've gotten. Okay. You know, when you're ready to come down, make sure you're careful, or I can help you, or whatever, right? You know, so there's things like that we don't recognize. You know, ego comes up, right? Oh, look at, you know, the way parents thought, well, yeah, did you see what Joe and Sylvia did to their house next door? You know, boy, they're really trying to up the neighborhood. They must be doing well, right? Make judgments. And, you know, oh, we wish we could do that. Or look at they bought a new car. Oh, you know, they must have a silver spoon because they bought a new car, but their debt's out the yin yang because they bought the new car. people make judgments without knowing, or they make judgments about themselves related to other things without knowing. So, you know, and then ego comes into it, right? That's the whole silver spoon thing. That's all about ego, right? Thinking that somebody else is better than them, or that they're better than someone else. It's all a matter of being able to know when these things are coming up for yourself and jumping out in front and being able to go, whoa, nope, not today, right? And then turning around, making commitments and being in action, right? A person with a silver spoon who sits on the couch and plays video games all day, unless they're doing it as a business, they're not in action. But someone who's an immigrant or whatever, or came from less than, and is an action taker and takes actions and is making sure they're moving the needle from A to B, that person is going to have a much richer life, and they're going to see their life as being more. And so, you know, that's what people have to be really aware of. The silver spoon thing, you know, that goes back to watching movie shows like The Gilded Age and whatever else, where they talk about, you know, oh, your new money, your old money, whatever. You know what? Money is money. If you've got it, great. If you earn it, fantastic. If you know how to invest it and keep it to build wealth for generations, fabulous.
Joel, do you have anything to add to that? Or did Keith cover it all well there?
They covered it well.
Okay, awesome. Okay,
I'll just comment as someone who did inherit some money that when you get an advantage like that, you can blow it or you can make good with it.
Yeah.
There's nothing inherently tainted about ending up with some resources. It's what you do with it.
And just think of the transfer of wealth that's coming.
Massive.
Like, what is it? It's like $1 trillion worth of wealth is about to be transferred from in our society, or from one generation to the next, as our baby boomers and older, you know, end up passing away. So there's a lot of people that are going to be ending up with a silver spoon. And as Joel just said, how they choose to deal with it is going to dictate which side of the coin they're going to end up on.
so I'm dying to ask you guys this one before you guys go. Okay, so who is someone you are following right now?
Following, you mean on the social media, or am I watching and listening? Because I drive an hour each way every day. So every few months, somebody new comes and I discover them. Right now, I'm listening almost frantically to Aaron Doughty. So he's amazing and great motivator, and well, to reach deep inside your soul and see where you are going wrong and where you're making mistakes. So right now I'm almost every day listening to Aaron Doughty.
Keith, Joel, do you guys have somebody that you're following right now?
Well, so I'm a fan of Simon Sinek and Darren Hardy. So I do follow information from both of them regularly. And I'd be amiss if I didn't say that, you know, my own mentor and coach advisor is Richard Dolan. So I do definitely follow him because, you know, I kind of have regular conversations with him.
Do you listen to Darren daily every day? Every morning?
A lot of mornings, not every morning. I look at the
Me too.
topic. Some topics I go that one's not an interest. So
yeah, I listen to him almost every day too. Yeah, 5 minutes.
Awesome. Joel, how about you? Who are you following right now?
It's more eclectic for me. I try to kind of go through and keep checking out diverse voices and thinkers. That's my method.
If you had to throw out a name there so that everybody else can just hang up and like go and research this person, who would that be?
Well, it wouldn't be about real estate or wealth building. It would be about current affairs.
Okay, well, give me a name, please.
Okay, well, I like Rachel Maddow's news reporting in the U.S. on MSNBC.
Okay, no, that's really good. Okay,
Yeah.
So if you had a crystal ball, what would you foresee as would take place in the next 6 to 12 months?
Oh.
Crystal ball.
Bumpy times.
Going to be
Yeah,
a lot
that's
of
the only thing
a lot
I
of
can
unsta-
say.
yeah, a lot of instability. Like the crystal ball that I see is instability. The crystal ball that I want to see is one of peace and unity.
Yeah.
So that we can all move forward.
Well said.
And I was reading today that apparently Shanghai, half of Shanghai is in lockdown because of COVID.
Yeah.
So if that is true, and we have another wave of COVID coming, so that adds up to the uncertainty that war and inflation is causing. So it's just, yeah, as Joel said, it's going to be a bumpy ride next year. A lot of factors playing.
So sitting in cash might not be a bad idea, right? Taking
Yeah.
the time to do your due diligence, taking the time to
Exactly.
maybe learn something new,
Yeah.
right? Do your research.
Well, I think the biggest risk is high speculation, highly speculative marketplaces. There are other things that are a bit more perennial, like homes.
Yeah.
All right. So we've got about a couple of minutes left. So I want to leave the floor with you guys to have any closing comments, anything that you want to share with the group. And then before you guys before you guys take the time to do your closing comments, I just wanted to say that for those of you who are still listening, like these gentlemen came on and they're not making a cent on this. Like I am not paying them anything. And so they agreed to do this because they asked me why, Huong, like why are you doing this? And I basically just said, look, you know what, there's so much uncertainty out there. There's so much fear. Let's just get together and talk about what some of the issues are. And so I just want to thank you. Like, I really appreciate your generosity with your time, because
Thank you.
that, you know, like you've given me knowledge, but also your time. And I just want to say thank you that you guys did this. And we are going to be giving a donation for for all the attendees that showed up to a charity. I got wind that maybe Red Cross might not be the one to go with. So I will do my research after the call to figure out where we're going to make that donation. But I just wanted to say thank you very much for you guys giving your time and giving your valuable advice and just sharing your expertise here. Okay, so I'm going to leave it with you three. What is your closing comments that you want to leave with everybody?
Joel, you're first.
Find good advisors. Take time to understand the subject area that you think you want to bet on. And pay attention to people with a lot of experience in it that may not be your advisor, but that you can read their stories and track how they pulled things off.
Good. Nader or Keith?
Just say from experience, do your research, but then take action. Don't sit on it. I mean, every time I sat on it and I didn't take action as an investor, I got burnt. So I'm telling you, take action. Just go with it. Make sure you've done your due diligence. Make sure you have your plan B, but go for it. Don't sit on it forever.
Keith, how about you?
Oh boy, Joel stole my answer, so I got.
So as you can tell, we did not plan this closing comment thing, right?
My final note is one that is engage yourself in being committed to your actions, staying true to your integrity and your values in everything that you do. If something doesn't fit your values, it probably isn't something that fits for you. And so stay true to yourself and your values. That's so important. And find people that you can, whether it's partners to be with, whether it's trusted professionals to work with, that have similar values, if you make that a part and focus of how you be and how you are in this world, it will make things so much more calm and fruitful for you going forward. And, you know, so for me, that's part of, you know, for me, my vision and my calling is everyone is living a life of abundance. And so for me, that's why this fit for me today, is because that helps me fulfill and satisfy that further. And, you know, my trademark is stay calm and mortgage on.
Stay calm in light of everything that's going on. All right. Okay, so that is 2 full hours. We've been on this for 2 hours. So thank you. I know time flies when you're having fun and talking real estate. So, hey, Nader, behind you, you have a book, a copy of your book. Do you want to just bring that to the screen so that people can see it?
Sure.
Because we will be sending that to everybody as well so that they can get a copy of that. That's a, oh, nice. Move it over. Oh, move it over. There you go. Yeah, so that's what that one's with Brian Tracy. That's fantastic.
Yes.
Okay, so Joel has a book as well for anybody who wants to buy books. Joel, what's the name of your book?
Called The Clean Money Revolution.
Oh.
It's a thick book, you guys. It is not an easy read. Like you have to be committed to reading it, but it's well worth the read. I've read it already, Joel, just to let you know. And Keith, we will get your book as well. So that's fantastic, which I put in the link for everybody. So thank you so very much, gentlemen, for being on the call and sharing your knowledge.
Thank you. Appreciate everybody's
thank
time.
you
Thank
enough.
you.
Thank you.
Thanks for the opportunity. Thank you.
You're welcome.
Bye.
Fantastic. Thank you. Have a good evening.
You're welcome. Thanks, everybody. Have a great night.